Okay, let's unpack this. Welcome back to another deep dive where we try to cut through the noise for you. Today, we're diving into a company that's, well, it's seen some really explosive moves lately, Gorilla Technology Group, that's NASDAQ ticker GRRR. And the big question we're tackling really is this. Is Gorilla on the verge of becoming, an essential AI backbone for smart cities, for nations? Or is this growth story maybe built more on promises that might not quite materialize? I mean, this is a company that surged over 44% in just one day, June 20th, 2025. That's the kind of volatility we're looking at today. And hey, if you're enjoying this deep dive, if you want more expert analysis like this, do me a quick favor, like and subscribe to the stockanalytics.ai YouTube channel. Remember, members get to suggest stocks in the comments for future deep dives, and we pick those up for priority analysis. So stick with us, and by the end, you should have a much clearer picture of Gorilla.
Yeah, what's really fascinating here, I think, is how a company can have such a compelling story, this narrative of transformation, talking about a multi-billion-dollar pipeline, and yet it's still very much a battleground stock, lots of intense scrutiny. So our mission today is really to sift through the data, cut through that noise, and give you a comprehensive, unbiased view of Gorilla Technology Group.
Okay, great. So with that high-level view, let's lay some groundwork. We're starting with part one, the foundation. And our first chapter is chapter one, business analysis, the AI engine for smart nations. Right, so to understand Gorilla Technology now, in 2025, you really have to see it as a company going through this, well, profound transformation. It started out primarily as a Taiwan-based video analytics software firm, but it's strategically shifted. Now it's a global provider of these really comprehensive AI-driven solutions, and they're focusing on the absolute foundations of modern society, things like smart cities, national security, critical infrastructure. It's a huge pivot, wouldn't you say?
Oh, absolutely, a massive shift. And their business model reflects that. It's not about selling simple off-the-shelf software anymore. Gorilla now uses this consultative, project-based approach. They're targeting these really large-scale, multi-year contracts, mostly with governments or quasi-government entities. They position themselves as like the central nervous system for these huge initiatives. They aim to be the one throat to choke, that single accountable partner for incredibly complex digital transformation.
Okay, the one throat to choke, I get that. Makes sense for big government deals.
Exactly. And what's really innovative, I think, is their revenue structure. They're using this performance-linked financial model. The best example is that landmark $1.8 billion Memorandum of Understanding, the MOU, with Thailand. That's for modernizing their national electricity grid. Now, for this 15-year project, Gorilla's revenue is actually tied directly to the efficiency improvements they deliver, the long-term optimization of the grid.
Interesting. Performance linked.
Yeah, it's compelling, but like you said earlier, it's a double-edged sword. This model needs huge upfront investments, capital, resources. A lot goes in at the start. And the bulk of the financial returns, the cash flow, that's projected to come much later. Think 2026, 2027, maybe even further out. So that explains why they're burning through cash in the near term, even with these massive contracts announced.
That makes sense. That consultative approach, the long payback period. Okay. But for listeners, what does Gorilla actually sell? What are they delivering? What's in this integrated stack they talk about?
Right. So what Gorilla's really selling isn't just a collection of AI tools. It's the promise of seamless integration that's critical for governments who are often overwhelmed by fragmented tech solutions. Their offerings, you can kind of break them down into three main buckets. First, you've got the AI models. This is the brain of the operation, basically. They're proprietary AI, deep learning algorithms. Think intelligent video analytics, facial recognition, vehicle analysis, that kind of thing. Also, security convergence algorithms, merging IT and OT, like industrial control systems for power grids to spot threats in real time, and network anomaly detection for protecting digital infrastructure.
Okay, so the software brains. What else?
Second, there are the AI appliances. This is the hardware layer. It's where these AI models actually run, often deployed at the edge, meaning, on-site, close to where the data is actually collected. These are products like their intelligent video analytics appliances, IVRs they call them, and specialized OT security appliances for industrial settings.
Got it. Software brains, hardware bodies. And the third part?
The third part is their AI SaaS platforms. These are more like turnkey, cloud-based software as a service solutions. Things like smart retail for analyzing shopper behavior, or smart city and transportation for managing traffic flow and endpoint security. So by offering this whole stack end-to-end, Gorilla presents this unified solution. And that's really attractive to these large government clients who don't want a patchwork of different vendors. They want one integrated system.
And it sounds like they're not just staying put in Asia anymore. You mentioned global provider.
No, definitely not. They're aggressively positioning themselves as a global player, expanding rapidly beyond their historical base in Asia. They're moving into the Middle East, North Africa, Latin America, the UK, the US. That new office in Bangkok they just opened. That's a clear sign of this global push, supporting that massive smart grid project in Thailand we talked about. Their core value proposition is really being that comprehensive end-to-end solution provider for governments doing these huge nationwide digital upgrades, offering to be the single point of contact for integrating AI, cybersecurity, IoT, all into cohesive national systems. Think border security, modernizing power grids, things like that.
They definitely seem to be riding some powerful market trends, too. What's the broader industry look like for them?
Oh, absolutely. Huge tailwinds. Gorilla operates right at the intersection of several critical, fast-growing sectors. You look at the global video analytics market, AI and security, cybersecurity. These markets are projected to see compound annual growth rates, CGRs, in the 20–25% range over the next decade. The overall security market alone could hit over $93 billion by 2030, even higher depending on the segment. These trends, they're driven by the explosion of IoT devices, the global push towards smart cities. It creates this massive growing demand for exactly the kind of integrated solutions Gorilla provides.
Okay, but what about competition? It sounds like a hot space. Who are they actually up against?
It's a diverse field for sure. You got the technology behemoths, right? Your Microsofts, Oracles, Palantirs. Huge resources there. Then there are the pure-play cybersecurity firms. Think Palo Alto Networks, CrowdStrike, Fortinet leaders in their specific areas. And finally, you have other small to mid-cap software companies, maybe more direct size comparisons. Gorilla's strategy isn't really to be the cheapest option. It's about being the most integrated solution provider, offering that complete package that maybe the tech giants aren't quite structured to deliver easily, and the smaller players just don't have the scale for.
Now, this is where it gets tricky, I imagine. Dealing with national security, sensitive government data. The regulatory environment must be intense. How do they navigate that?
You're absolutely right to flag that. Operating in government security spaces means dealing with a really complex web of international laws. Data privacy regs like GDPR, sensitive stuff like facial recognition. It's a minefield. And in that context, Gorilla achieving full Sarbanes-Oxley compliance, SOX compliance back in April 2025, that was actually a really big deal. They did it 2 years earlier than they were required to as an emerging growth company.
2 years early, why?
Well, it seems like a deliberate move to de-risk their profile, especially for institutional investors. It signals strong internal controls, accountability. It's kind of a foundational step if you want to move from being seen as just a speculative stock to a more institutionally backed company.
Okay, makes sense. Build that trust. So what about barriers to entry then? Is it easy for someone else to just jump in and do what Gorilla's doing? Do they have a solid moat?
Not easy at all, no. The barriers are pretty substantial, which helps build that moat. First, there's the sheer relationship and trust required. Winning these multi-year, multi-billion-dollar government contracts, that takes deep, long-standing relationships, years to build, often. Second, the technical complexity and integration, building and deploying a national-scale platform that seamlessly integrates AI, IoT, cybersecurity. That's a monumental engineering challenge, just huge. And third, the capital intensity of their business model. We touched on this. Especially with performance-linked revenue, you need serious upfront investment before you see significant returns.
So relationships, tech complexity, capital, what else adds to their moat?
Well, their brand strength is growing, particularly in their niche. Partnerships with big names like Intel, Red Hat, Cisco help there, as do these major projects like Thailand or the Internet of Forests in the Amazon. Their global delivery model, using teams in Taiwan, India, UK, USA, Egypt, that aims for future cost advantages, though the real test of economies of scale is probably still coming. But arguably, their strongest, most durable moat element is network effects, or switching costs.
Ah, the lock-in effect.
Exactly. Once their platform is deeply embedded in a nation's critical infrastructure power grid, security systems, the cost and the operational risk of ripping it out and switching to a competitor, exceptionally high. That creates incredible stickiness. And finally, they do have unique assets and capabilities. They hold 29 granted patents, 27 registered trademarks. Beyond IP, their ability to actually help structure and finance these massive projects, acting as more than just a tech vendor, that's a unique strength too.
All right, that gives us a good picture of the business itself. Let's shift gears now. Chapter 2. Management evaluation. The architects of the turnaround. For a company making such a dramatic strategic pivot, leadership has got to be absolutely critical, right?
Absolutely. Crucial. The quality, the alignment of the leadership team, it's paramount here. You've got Jay Chandan, the chairman and CEO. Now, he's not your traditional engineer type. His background is more as a serial investor, a deal maker, lots of M&A experience, which you could argue makes him uniquely suited for securing these huge government contracts, navigating those complex negotiations. Then there's Bruce Bauer. He became the permanent CFO on June 1st, 2025. He's been spearheading their financial restructuring and, importantly, led the charge to get that early SOX compliance.
And how have they handled challenges like those short seller reports?
Well, their response has been pretty proactive and aggressive, actually. When reports came out from folks like Citron Research, the Bear Cave, back in March 2025, management issued press releases directly refuting what they called baseless market speculation. They consistently stood by their fundamentals, tried to control the narrative.
Okay, but speaking of narrative, Jay Chandan comes across as exceptionally confident, right? Unbeatable platform, pipeline exploding from $2.2 billion to over $5 billion. Is there a risk that level of optimism might be a bit premature, especially for a company still really in its heavy investment phase? And I notice they use RedChip companies, an investor relations firm, and pay them with both cash and stock. Does that maybe raise potential conflict of interest questions for listeners to consider?
That's definitely a fair point and something investors need to weigh. That confidence versus the current financial reality. As for their capital allocation strategy, it seems pretty clearly defined and focused on growth. Their stated strategy is 75% build, 25% acquire. So prioritizing internal R&D, but also making strategic acquisitions, like that safe investment in the One Amazon project, taking an equity stake to be a foundational partner.
And they've been buying back shares too, haven't they?
Yes, aggressively. They completed $5.4 million of a $10 million buyback program by May 2025, which raises that important question you alluded to. Why do that when you're burning cash? Well, it signals strong management belief that the stock is undervalued. And that conviction, I think, is powerfully reinforced by the significant insider ownership. Management and the board collectively control nearly 20% of the company.
20%, wow.
Yeah, and importantly, achieved through personal open market purchases, not just stock options, but buying shares with their own money. That's real skin of the game. Signals strong alignment with shareholders. As you'd expect for a high-growth company, no dividend, not expected anytime soon. And historically, their return on invested capital, ROIC, it's deeply negative. Minus 65%, minus 130% because of past losses and all this heavy investment. So the core investment thesis here really is a high-stakes bet on a massive future payoff, banking on these huge long-term projects, eventually turning the financial health from deep red to hopefully robust black.
Okay, that's a perfect lead-in to Chapter 3, Financial Analysis, from red to black.
Right, so context first. As of June 20th, 2025, after that big jump, GRRR's market cap was around $548.63 million, closing price $27.13.
And the revenue growth trends. They really tell that story of dramatic change you mentioned. There was a decline in 2021, 2022, apparently a deliberate move away from lower margin stuff, but then, boom, a staggering 188.7% growth in 2023, hitting $64.69 million. And that momentum seems to have continued. Q1 2025 saw a 109% year-over-year revenue surge to $18.3 million. And management's guidance for the full year 2025 is pretty bullish, $100 to $110 million.
Yeah, and the profit margins show a similar, though maybe slightly more complex, turnaround story. Gross margin improved significantly, up to 69.1% in 2023. That reflects the shift to those higher value projects we talked about. Net margins, though, were heavily distorted in the past by big one-time non-cash expenses, like a $70 million charge related to the SPAC deal in 2022. Stuff like that really muddies the waters historically. But the positive sign, the green shoot maybe, is Q1 2025. They reported positive adjusted net income of $4.47 million and adjusted EPS of 0.23 cents. That's a sharp turnaround, and it suggests maybe the beginning of sustainable profitability, at least on an adjusted basis.
Okay, adjusted profit sounds good, but what about actual cash? What does this all mean for free cash flow, FCF, generation? With all that upfront investment you described, I'd still expect that to be under pressure.
And you'd be absolutely right to expect that. FCF remains a significant concern. It's been persistently negative, and actually increasingly so. It hit negative $31.11 million in 2024. And that's a direct consequence of the business model we discussed. Heavy upfront investment in hardware, deployment, Personnel for these huge long-term infrastructure projects, the cash payments from these contracts, they come in over many, many years. So the whole investment thesis really hinges on this period being a temporary investment phase. The hope, the bet, is that this will reverse dramatically once these large contracts mature and start spitting out substantial, high-margin cash flow down the line.
Right. So despite that cash burn, you're saying their overall financial stability seems okay. How are they managing that?
It does seem surprisingly robust on some metrics. I mean, earnings consistency is still, a work in progress. But Q1 2025 was definitely a positive data point. Their debt-to-equity ratio was actually very healthy, very low. Between 0.19 and 0.07 recently, they've been actively paying down debt, which is good discipline. And their current ratio, a measure of short-term liquidity, looks strong too, around 2.48 or 1.68, depending on the calculation, suggesting a solid buffer. And again, no dividend.
Okay, so let's talk valuation. When you've got that history of losses, how do you even value a company like this? Can we use a standard PE ratio?
Yeah, for a turnaround story like Gorilla, looking at historical price to earnings is pretty much meaningless because of those past losses. So you really have to focus on the forward PE ratio, based on analyst estimates for future earnings. As of June 20th, 2025, that stood at about 24.89. Now, if you compare that to some peers, Palantir trades at something like 256 times forward earnings, CrowdStrike maybe 77 times, even Fortinet is around 25 times. So Gorilla's forward PE at around 25x actually looks quite reasonable, maybe even inexpensive if you believe the growth story and the path to profitability.
Suggests potential for a re-rating then if they execute.
Exactly. It suggests potential for a significant re-rating if they can successfully deliver on their strategy and those earnings materialize. Now, if you try an intrinsic valuation using discounted cash flow, a DCF model, you have to remember, DCF is just a framework. It's highly sensitive to the assumptions you plug in. For Gorilla, you'd have to assume very high initial revenue growth, say 2025 through 2027, given that multi-billion-dollar pipeline they keep talking about. You'd also need to use a pretty high discount rate, maybe 15–20%, to reflect the significant risks involved, execution risk, timing risk, etc. And you'd have to assume they reach decent EBITDA margins, maybe 20–25%, once they mature. Based on assumptions like those, the estimated intrinsic value range for Gorilla comes out somewhere between, say, $24 and $42 per share.
Okay, $24 to $42. We'll come back to that range later. Let's transition now to part 2, the broader picture. And chapter 4, market sentiment. A battleground stock. You called it a battleground stock earlier, and it really feels like it. What's the general market perception, starting with Wall Street analysts?
Well, the analysts who actually cover Gorilla, they're overwhelmingly bullish. The consensus rating is a strong buy, like a perfect 1-point your average broker rating. And their average price target is around $31 to $31.62. Even after that big 44% jump on June 20th, that still implies roughly 14% upside from the closing price that day.
Okay, so analysts are bullish, but the general media tone, the chatter online, it feels much more polarized, doesn't it? Like a real tug of war.
Absolutely. It's this constant push and pull. On one side, you have positive company news, these big contract announcements beating earnings expectations in Q1 2025. And on the other side, you have these negative reports from well-known short sellers like Citron Research and the Bear Cave, questioning the story, the valuation, the execution. What's fascinating here, I think, is how this public back and forth creates this really highly charged, noisy environment around the stock, and that directly fuels the extreme volatility we see.
That volatility definitely exploded on June 20th. Can you break down the market indicators around that? What exactly drove that incredible 44% surge?
Right, so looking at the indicators, the short interest is significant, about 1.24 million shares shorted, which is roughly 6.5% of the float. So there's definitely a dedicated group betting against the company. However, leading up to and including that day, the stock was trading significantly above both its 50-day and 200-day moving averages. That signals strong bullish momentum technically. So that June 20th price action was really a microcosm of the whole Gorilla story. The stock gapped up significantly at the open because those Q1 earnings absolutely crushed expectations. That provided tangible validation for the bulls. Proof may be that the turnaround was real. That catalyst, hitting stock with notable short interest, likely triggered a short squeeze. Shorts rushing to cover their positions, pushing the price up further. And then apparently there was massive speculative call option buying on top of that. Over 15,000 options traded, betting on further upside. So you had strong earnings, a likely short squeeze, and heavy option speculation all converging. Boom, 44% surge. It just shows how sensitive this stock is to news and that tension between the bull and bear camps.
Wow, quite the cocktail. Okay, let's move on to chapter 5, ownership structure. Who's at the table? Who actually owns GRRR stock?
Well, looking at the stakeholder analysis, the top institutional ownership is currently quite low, somewhere around 10–12%. That's pretty typical for a small cap company that came public via a SAPAC, which Gorilla did. However, if we connect this to the bigger picture, the trend here is critical. Institutional holdings actually increased significantly, jumping from just 0.65% to 7.46% in the fourth quarter of 2024. You're starting to see names like Anson Funds, Bank of America, Morgan Stanley, Jane Street Group appearing on the holders list. Still small positions, but they're there. And that early SOX compliance we talked about, that's a direct attempt to make the stock more palatable, more investable for this large, essentially untapped pool of institutional capital. They want the big funds to be comfortable buying in.
Right, trying to attract the big money. But you mentioned insider holdings earlier. That seems like one of the really compelling aspects here, doesn't it? Management putting their own cash in.
It really is, I think. The insider ownership story is strong, it's high, and it's been actively increasing. Like we said, management and the board of directors collectively control nearly 20% of the company. And crucially, this was achieved mainly through personal open market purchases, buying shares in the open market with their own money, particularly in April and May of 2025. That's not just getting options as part of compensation. That's a powerful vote of confidence. It's a strong counter-narrative to the bearish arguments showing insiders truly believe in the company's future.
So, high insider ownership, but still relatively low institutional ownership. Who holds the rest?
Currently, the ownership structure is heavily dominated by the public and retail investors. They hold roughly 75% of the shares. And as you often see with stocks popular among retail investors, this high retail concentration is a primary driver of the stock's extreme volatility. Sentiment can shift quickly, leading to big price swings.
Okay, that makes sense. Let's put it all together now in Chapter 6, risk assessment. Navigating the obstacles. We can use a SWOT framework here mentally. We've covered the strengths proprietary AI, winning big contracts, experience management, that huge $5 plus pipeline, strong balance sheet on some metrics, and opportunities, massive market potential, global expansion, cross-selling, potential for that re-rating. But let's focus on the flip side. What are the key weaknesses and threats investors really need to keep front of mind?
Okay, so on the weaknesses side, that history of significant net losses is undeniable. The persistent negative free cash flow is a major concern. There's high customer concentration risk, relying heavily on a few very large government projects. And maybe the biggest internal weakness is the sheer execution risk. These are incredibly complex global projects, often on a scale the company hasn't delivered before. There's a real risk they stumble in execution. Then, threats. Intense competition, obviously. Ongoing pressure and scrutiny from short sellers. Geopolitical instability is a factor, especially potential Taiwan-China tensions, given their roots. Macroeconomic headwinds, sustained high inflation, rising interest rates could pressure government budgets, potentially delaying or shrinking these big projects, and currency fluctuations, like dealing with the Egyptian pound on certain projects, can impact results. But tying it back, this raises the key question again. I think the most significant risk, overshadowing almost everything else, is internal execution. Can they actually deliver profitably on these unprecedentedly scaled and complex projects, from deserts in the Middle East to the Amazon rainforest? Remember, MOUs, Memorandums of Understanding, are not guaranteed contracts. They have to convert them and then deliver.
That execution risk sounds massive. Beyond that, can you elaborate a bit more on the specific macroeconomic and geopolitical factors? You mentioned potential U.S. tariffs.
Right. So macroeconomically, if high inflation persists and interest rates keep climbing, governments might face budget pressures. That could lead to delays or cancellations of the very large-scale infrastructure projects Gorilla targets. It's a real risk. Geopolitically, beyond the Taiwan situation, consider something more concrete, like hypothetical U.S. tariffs. Say the U.S. imposes a 10% tariff on most U.K. imports in 2025, as has been discussed politically. That could directly impact Gorilla's business, because they sell and deploy physical AI appliances and hardware infrastructure as part of their solutions. If they're sourcing or moving hardware through the UK to the US, those tariffs would increase their costs, squeezing margins on US-based projects. It's a tangible example of how geopolitics can hit the bottom line.
Okay, that paints a clear picture of the risks. Let's try to wrap this up. Chapter 7. Conclusion. A high-stakes wager on execution. So if we synthesize our findings, the bull case for Gorilla seems pretty compelling on the surface. You've got a company at what looks like a clear inflection point, explosive revenue growth recently, signs of adjusted profitability emerging. Visionary management seems aligned with shareholders, significant insider ownership, real skin in the game, a massive, and they claim verifiable project pipeline topping $5 billion. They're strongly positioned in these rapidly growing markets, AI, cybersecurity, smart cities, and potentially still undervalued compared to some high-growth with peers even after the recent run-up.
But then, the bear case presents equally forceful counterarguments. There's that extreme execution risk on projects of unprecedented scale and complexity. That's probably number one. There's the persistent negative cash flow, raising legitimate questions about future funding needs or potential dilution. High customer concentration risk, what happens if one of these mega deals goes sour. And it's undeniably a volatile battleground stock, highly susceptible to shifts in sentiment and news flow, both positive and negative.
Okay, so let's revisit that valuation summary. You gave us that intrinsic DCF value range of roughly $24 to $42 per share, and the closing price on June 20th, after that 44% surge, was $27.13. So before that big jump, the stock looked potentially quite discounted relative to that range. Now, it's trading comfortably within the lower end of the estimated value range. What does that suggest to you?
Well, it suggests the market has started to price in some measure of success. It's acknowledging the positive developments, like the Q1 earnings beat and the pipeline growth, but the fact that it's still in the lower part of that range, even after such a huge move, indicates the market still harbors pretty significant skepticism about Gorilla realizing its full potential. There's still a big show-me element priced in.
Makes sense. So the final outlook.
Yeah, if we connect all this back to the bigger picture, I think the investment outcome for Gorilla Technology Group, ultimately, is going to be determined by one thing: management's ability to execute. Can they convert that ambitious vision, that massive pipeline, into tangible, profitable, and crucially sustainable cash flows? That's the multi-billion-dollar question.
So, as you, our listener, reflect on Gorilla Technology, maybe ask yourself this. In this era of accelerating digital transformation and rising national security concerns, how much will governments truly value having that one throat to choke for their most complex AI and infrastructure projects? And perhaps more importantly, can Gorilla Technology Group actually deliver on that immense promise globally? If you found this deep dive valuable, please remember to like and subscribe to the StockAnalytics.ai YouTube channel. We do more in-depth analysis like this, tailor-made for curious minds like yours.
And finally, just a quick reminder, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Knowledge is definitely most valuable when it's properly understood and carefully applied.